This meeting is being recorded.
The remix. All right, so hey guys, thanks for joining us. We are going to talk with David Dropsy. David Dropsy is one of our preferred lenders. I've worked with him dozens of times to close deals on homes. He's a great lender, good communicator. So I will scream his name from the mountaintop as a person you can trust to take care of your clients no matter where you're at. David has just kind of brought some information to my knowledge that I think is really going to be imperative for us in the with the market as it sits today and how we can best service our potential clients. Most of us in our first year in real estate help primarily buyers because there's just more of them out there. And when we're helping buyers, a lot of times they can get freaked out or scared quite easily based off little things. I wouldn't call interest rates rising to over 7% a little thing, but that's definitely a deterrent in regards to us trying to sell more homes. There's not a ton of people lining up right now when interest rates hit double where they were last year saying, I'd love to buy a house and spend $1,000 more a month, right? But there might be a solution to that. And David is going to talk us through adjustable rate mortgages, what they mean, and all that jazz. David, do you happen to have slides to share? Would you like me to make you the host so you can share your screen? I believe he said yes. So I'm going to make you the host. Okay, David, you should be good now to share your screen. And I'm gonna kickstart it with us just asking a simple question. In my almost 5 years in real estate, I have never one single time had to use an adjustable rate mortgage, nor have I heard of anyone using one. And so when you brought this information to my attention, I said, I'd like to learn about this. And not only would I like to learn, I think it'd be really beneficial for our brand new agents to get a competitive edge. So David, first off, what is an adjustable rate mortgage or an ARM? You're muted, I think. While he is trying to fix that, I will buy time. Has anybody here on this call ever used or heard of, there he is, an adjustable rate mortgage?
You guys hear me?
Yes. All right, take it away. What's an ARM?
So an ARM is, yes, it's an adjustable rate mortgage. And it is basically, it's going to scare a lot of people. Okay. It can be it got a really bad rap during the sort of the 08, 09 crisis. There were a lot of different types of ARM products out there, and they weren't always that great for the client. And they were set up in a way that they now carry, a bit of some negative, feelings about them. But they are simply this: they are a 30-year mortgage. And then you are buying yourself a lower rate for a determined amount of time. Typically, it's anywhere from 3 to 15 years that the rate is still fixed. After that determined time that you select as the client, it will then go to an adjustable rate product where every year it's going to reset to whatever the market is. Why that's scary is, during 08, 09, when, some lenders and buyers who had no business buying a home or the size of home that they were buying, they were really doing some really unique products where it was not just the regular ARM product, it was more of almost a pick your payment. And where a lot of people weren't even paying enough to pay down the interest every month. So they just kept accruing more money on their loan. Obviously, that's a terrible loan product and never would sell that. But the ARM product kind of got lumped in with that sort of mentality for a lot of people. But at the end of the day, you could pick this type of loan product, and it would allow you to secure a much lower than your standard 30-year rate for a determined amount up front. So for example, you'd be looking at, the standard is like a 5 or a 7-year ARM. Why is that the standard? Well, most people don't live in their homes. Some people live on average, I think it's like 7 years. You guys could tell me that a little bit better. But sort of the cycle through for most clients is about 7 years. So if you have you get yourself in a 7-year ARM, if you end up selling the home, then that adjustable period, you're never going to see it. And so it's a way for you to really drive down that rate and still then not really set yourself up for the potential of higher rates down the road, even after it adjusts, because a lot of people are going to end up probably cycling into a new home. Or the main message that we're trying to deliver is, with rates in the high 6s, 7s, as Josh had mentioned, these are some of the highest rates we've seen in the last 20 years. And the chances, obviously, none of us know what's going to happen 100%, but the probability that rates are lower down the road in the next several years, that probability is high. And because that probability is high, if you've locked yourself into a much lower rate for, say, 5 or 7 years, and 3 years from now, we're back down to rates in the 4s and 5s, you're going to have an opportunity to then refinance. So you still never experience the adjustable rate portion of the loan, because most people don't carry a loan that long anyway. And so just as an example, I myself bought my house with a 7-year ARM. I did that several years ago. It was my plan to not be in this house past the, basically 6 to 7 years. That plan is still, I'm still on that path. But during when the rates were super low 2 years ago, or not even about a year and a half ago, I was able to refinance to an even lower rate to a standard 30-year fixed. So even my plan, I was able to adjust just due to the market that happened with rates. And what this does is, this is an enormous way to overcome your buyer's objections when it comes to rates. I know you guys are hearing it a lot. You're probably seeing less buyers come into your pipeline. You're having less people reaching out to you. You're having less people apply for a mortgage to get pre-approved. I know I'm seeing that. And it's heavily tied to the interest rate environment that we're in. This is a way for you to help you overcome your specific buyer's hesitations about buying a house when it comes to these interest rates. So we have at Guaranteed Rate, we have secured with a single credit union an ARM product that is separate from a standard Fannie Mae, Freddie Mac ARM product. It is exactly the same, except that the loan is not being bought or sold through Fannie Mae. And basically this credit union has set their own rates. They do not care what the market rates are. And they have come in extraordinarily low. If I just priced a similar loan out for an ARM product, we are not through Fannie Mae, we are not getting very good pricing. But specifically with this credit union that I'm able to write a loan with, we are seeing rates in the 4s for up to even a 10-year ARM. So I'm going to try to share this. I'm on 2, and you guys can hear me okay, right?
Yes.
Okay. I'm on it twice because my microphone wasn't working on my computer. There. All right.
Yeah, we see it.
You can see this screen? Okay.
Yeah.
So this is from the credit union's marketing material. I just took a little snippet of it. Okay. It comes with caveats. The main caveat is that this is specifically for at minimum a 10% down payment. So if it's a client that's only got, 3-5% to put down, this is not something we're going to be able to utilize. But if you've got a client that's maybe selling a house and upgrading, or maybe an older client who's downgrading, they're going to have equity that they're going to want to put anywhere from 10 to 20, 25% down. I am telling you, these rates are ridiculously low to the marketplace. And the reason we have access to them is specifically this credit union that we have an underwriting correspondence with. And they have their deposits. So they are giving their deposits out with these rates. They do not care what the market rates are. So they're well below market rate. So you could get someone, if you had a client that was worried about a 7, high 6% rate, they could lock in for 10 years. This is a 10-year ARM, okay? Every number on the left side of the hash is the amount of years that the loan is fixed. All of them are 30-year loans. So they work just like your standard 30-year fixed rate mortgage. There's really no difference except that after this defined amount of time, then it goes into an adjustable period where it's going to move with the market. But again, the philosophy, the theory is if I locked in for a 7-year ARM, what are the chances at 4.625%? What are the chances that 7 years go by and I either 1, still own that home, or 2, in 7 years, will rates be below 4.625 at some point? The probability of that is extraordinarily high. And therefore, this is a very unique opportunity to help your buyers secure something that, again, this is through one specific credit union that we have access with. And I just don't, this is going to be something to help you overcome that objection.
David, can you help me explain underneath the product column, it says 3-1, 5-1, 7-1. Can you explain that a little bit further, exactly what that means?
Yep. So every number to the left is the number of years that this rate would be fixed. So and as you can see, each rate gets a little bit higher. It's because you're protecting yourself for a longer duration. So on the first one, you've got a 3-1 ARM, meaning for the first 3 years, you're going to have a rate of 4.5%. After that, every year it will adjust 1 time per year. It will adjust. That's what the 1 denotes, right? And it will basically, it's prime plus, I believe it's 2.5 is the margin. So you'll never know what that rate's going to be until you get closer to that point of time in the future. But essentially, this loan is there to protect you for 3 years at this low rate. As you can see, though, each duration gets longer and longer. So you're protecting yourself with this fixed rate for a longer period. So a 3-1 ARM, just to get us a little bit lower rate, is not something I necessarily would advise. Because if I'm the customer and I'm looking at this sheet, I would probably pick a 10-year ARM because I'm still getting a pretty great rate in today's market at 4.75, and I'm protecting myself for a decade. That rate will not change from 4.75 for 10 years. So that's what everything on the left-hand side is, the amount of years that rate is locked. After that, it's going to adjust.
And you're still able to refinance if it goes lower than that 4.75?
You could refinance it anytime. There is nothing preventing you from refinancing. You don't have to wait. Again, this is just a standard 30-year mortgage outside of the fact that the rate is fixed for a shorter than 30-year period. After that, it starts to adjust. But nothing would prevent you from refinancing in the future, even before the ARM starts to, even before the adjustment period. Equally, if you sold the home in 8 years, right, you're satisfying this mortgage and paying it off when you sell the home, and therefore you're never hit with any adjustment period. So these loans are not, I will be honest with you, I don't sell a lot of ARMs, or I don't put customers in a lot of ARMs because a lot of people are a little leery because of some of that history that I was alluding to. But it is, and it's something where the difference between a 30-year fixed and say a 7-1 ARM typically is just a small amount. So you're not getting much bang for your buck. Fortunately though, with this credit union, they are so much below market. I mean, this is almost 2 percentage points below current market rates right now.
I just ran a quick, just to interject, I just ran a quick calculation on a free mortgage calculator. If you guys don't have a mortgage calculator on your phone, I want to encourage you, there's plenty of free options there. Go to the App Store and find a mortgage calculator. That way, in case a buyer ever has a question about how much in a ballpark situation, how much their mortgage payment might be, you can at least sound like you somewhat know. But I did a $350,000 house at 7%, which is where we're currently right around. And that monthly payment with 10% down was about $2,600. $2,600 at 4.75. So let's say you went with a 10-year ARM, you're looking at saving $500 a month on your payment, and that's locked in for 10 years.
Yep.
So $500. I don't know about you guys, but I could use an extra $500 in my pocket every month. And the whole reason for this conversation to even happen is that this is another tool in our tool belt that we can, as David said, overcome objections with. Like, as the local experts in real estate, you've got to be well equipped. And I'm going to bet you that 90+% of the other realtors out there don't know about ARMs at all. And so now you're equipping yourself. So good job being on this call. What else on this stuff, guys? What questions do you have? Interject as you wish.
Yeah, feel free to fire away.
Can you explain the price adjustments a little bit at the top?
Yeah, so it basically, this credit union, I mean, their underwriters, the way they developed it, they must have basically assigned certain metrics that they wanted to attract maybe certain dollar amounts, because it probably just fits within their deposit realm. Basically, the minimum loan amount would be $200,000, and the minimum credit score is 680. You can see that right there in the middle. And then there are some adjustments. So what it technically means is, like, if you had a loan less than 350,000, like let's say you have a client and their loan just works out to say 300 even, I would have to technically add 0.25% to these rates that are listed below. So if it was only a $300,000 loan, at 10-year ARM would be at 5% instead of the 4.7. So it's just letting you know that there's an adjustment to the rate. If the client's credit score is between 680 and 700, there's no hit to them. And then obviously, if it's a massive loan where you've got a jumbo $1 million plus, it's going to be rare, right? But they're basically saying, hey, we're not going to print anything with our rates on that. You've got to call and figure that out from us directly. So that's all. It's just trying to show you that if it's the larger the dollar amount, you're getting these stated prices, and then there would be a small hit to the rate if those loans are below that 50 threshold.
What other questions on this stuff, guys?
What are you guys really getting some feedback from clients talking about rates? Is that like one of the number one thing that is sort of in the conversations you're having with buyers? Is the first thing out of their mouth, man, these rates are really high?
It is for me. I'm hearing that as one of the top objections that we're seeing right now.
Okay. So this is one component. I know Josh put this up as sort of the main reason for the call. There is something else, but I don't want to go to the secondary thing until we've, addressed any questions and whatnot here.
David, I would love to hear a lender's perspective on why the interest rates are creeping up. And again, guys, listen up to this, because a lot of our buyers, they need educated, and this is where we come in. So, we can talk about inflation, but I'm interested to hear, David, from your perspective, like lender jargon, like why are interest rates rising? What's the diagnosis for how long this could continue? And what are you hearing on your end?
So I get a market update from our head of capital markets every day, pretty much every day. In fact, it just came out right before. I haven't even had time to read this because it came out right as we were kind of getting on the call. Inflation is the number one thing at the end of the day that's driving these rates up. The Federal Reserve, which sets overnight rates are what the bank borrows. Basically, when a bank borrows money from another bank, they're paying whatever the Fed funds rate is. That is not necessarily mortgage rates, but it dictates then what all the rates from credit cards, cars, mortgages, all across the board. It's the foundational piece for those rates. In an effort for the government is trying to curb inflation, and the only way that they really see that the method that they're using right now to curb inflation is basically trying to bump up interest rates, which tamper down demand for goods and services. And what generally happens is we get into a rising rate environment like we are in right now with the Fed funds rate, which is, again, that foundational piece. And it does trigger, basically, likely it's going to trigger a recession. It almost happens every time. With the recession, you're going to see some job losses. You're going to see businesses slowing down what they spend their money on. You're going to see consumers slow down what they spend their money on, and inflation generally does come down. Once that has happened, you start to see mortgage rates decrease pretty rapidly after they've done this cycle. It's typically about a 6 to 18 month cycle if you take out what happened in 2008, because 2008, 2009 was its own little crazy world. On top of that, it's not just America, right? There are basically European players in this, Asian players in this. Those banks, everyone is seeing inflation across the board in this post-COVID sort of demand rush, right? So you're seeing banks in Europe, you're seeing banks in England, you're seeing banks all over Asia. They are also doing something very similar. So you're not seeing just America trying to tamper inflation by raising rates. You're seeing rates rising all over the globe. And that is putting a lot of fear in holding a fixed asset like a bond. And all mortgages are bonds. A bond basically it has a stated interest rate on it, and that's what it's paying you off of. Well, if I bought a bond last year at 2%, and now I can buy a new bond today at 4%, my old 2% bond isn't worth very much because I'm getting far less money than I would if I was just going to buy a new bond today. And so if I wanted to say sell that bond, the prices of that bond are going way down. And that is basically, you're seeing all of this translate into the fear of what inflation is doing to us. The bond prices are falling, which means the rates are rising. And that's translating to these higher mortgage rates because everything is kind of all tied together.
So without, and you gave an awesome explanation. Paraphrase that for us so that we can sound smart too. So give us like a 10-second, like, hey buyer, here's why this is happening.
We are in a highly inflationary environment right now. So inflation is definitely the highest we've ever seen. It's the highest in my lifetime. It's probably the highest in anyone's lifetime here on this call. Inflation is high. The government is trying to reduce inflation because inflation can be a very deadly thing for the economy. And so by them fighting inflation, they are raising interest rates, and all interest rates rise together and they fall together. So the government's fighting inflation. That means interest rates are rising, and that means mortgage rates are rising because it's the entire money system it flows with those foundational interest rates from the Fed. And so because of that, again, inflation, basically the root cause, it's driving up rates, it's driving up mortgages. But everything is a cycle. And the good thing that we know is that if we're in a high inflationary period now with high mortgage rates, again, we can't predict this. We could be at 10% next year and I could look like a fool, but I'm guessing that we've seen hopefully the highest that we're going to see, because again, the inflation you're starting to see inflation numbers coming down because what the Fed has done with these rates, again, the inflation going up, the fear of inflation is driving the rates up and causing the mortgage rates to remain high. But we are likely in the peak, and we are going to cycle through to hopefully lower rates in the next 24 months.
And it's funny that you said 24 months. What I've heard from multiple people in the similar positions as you is that what everything that they're hearing is that we can expect for this to last, to your point, another 12 to 18 months. And we could expect to see a turn within the next 2 years. So as realtors, we talk about pivoting or shifting. We talk about changing how we go about doing business. I don't know about you guys, but I'm already seeing a change in our market where homes are starting to sit a little bit longer. We were in a super intense seller's market just a couple months ago. And now I've got listings that are not moving like hotcakes. So it's really important for us to understand this stuff, the why behind it, so that we can educate our folks and maybe back them up off the ledge and say, hey, this isn't going to last forever, likely. Again, we can't guarantee anything, but we caveat that with, this is what I'm hearing from people in important positions. So thank you for all this information on ARMs. Are there any other questions about adjustable rate mortgages before David moves on to the next topic?
And just so you guys are aware, again, this is the reason why I could do this call with you guys, because you are in Central Ohio. I work with agents all over the country. This specific ARM product is something that is only local, right? So I've got agents in Philly. A couple of you guys met them at our party that we had a week ago or so. I can't do a call like this with them. This is something specific for. We've negotiated directly with this credit union here in our local branch, and so it is something a bit unique. You don't need to be like a hands-on expert. You don't need to know everything. Like, you don't need to know all the devil of the details. The point of this message that I wanted to get across is that when you're sitting there at the kitchen table with a client and they're like, I don't want to buy a house right now because rates are so high, you can immediately give them, hey, I have multiple solutions for that, and this is one of them.
I will say also though, David, because we do have a couple agents on here from Kentucky, that I will bet that there are some local products there in Kentucky that will do similar, maybe not exact same numbers, but go to your lender that you trust in Kentucky and get educated on what their structuring looks like, because you can still utilize the same information for your clients.
Thanks for bringing that up, Josh. This actually will go into Kentucky. So it's a credit union in Southeast Ohio, and they've drawn a map, it has to be within 100 miles of one of their branches is the rule that they've set up. And that will go into Kentucky and Indiana. So it is something that now it's not going to go deep. So I don't know what part of the state you're in. But if you're in Lexington or in the northern Kentucky area, it is still something that you'd be able to utilize as well. So thanks for mentioning that.
Cool. Take us on to the next topic you had for us.
All right. So this is sort of that's arrow number one in your quiver, right? Arrow number two is this. I'm going to ask you all a question. As Josh just mentioned, right? Homes are sitting on the market longer and longer than you guys have ever experienced in quite some time. Especially if you're new at it, at this job, you've probably never seen where homes sit for more than 3 days. My question to you guys is, can you negotiate in this market now where you now have some bargaining power as a buyer's agent? Can you negotiate between a 1% and 2.5% seller credit of the purchase price? If the answer to that question is yes, then the objection about rates from your client should never come into question. What we have is, it is called a 2-1 buy down. Okay, you're all gonna wonder what that is, and I'm pulling up my calculator for it right now. So give me 1 second so that I can visualize this with you. What this means, the reason why I say, can you negotiate that credit, is so rule number one of this 2-1 buy down is that it has to be seller paid. The buyer cannot pay for it. Okay, so that's rule number one. That's why I'm asking, can you get a seller credit? If you can, the math works out to approximately 2.5% of the purchase price is how much it's going to cost to do this loan program. What this loan does, so I'll even adjust some of these numbers. So let's say you've got a client buying a $400,000 house, right? And you guys can see the Excel sheet, right?
Yes.
Okay, cool. All right. So you got a client, this is actually purchase price, so just ignore that. So 400,000 is the purchase price, putting 10% down, so they have a loan amount of 360,000. And let's say the current 30-year fixed rate is 6.75%. What this does, in year one, your client, your buyer, our buyer that we'll be working with together, would get 4.75% as their interest rate for the first year. That is going to save them $457 per month for the first year. In year two, their rate will effectively go to 5.75%, which will still save them $234 per month. From that point on, from year 3 through 30, their loan will just go back to the same standard 30-year fixed rate that they got when they signed up to buy the house with the loan. So this is, it's a bit of a twist. It's not necessarily an ARM product, right? Because it's not going to adjust anything other than what's written here, right here in front of you. But let me ask you this. If you dropped the purchase price by 2.5%, can any of you guys guess? So let's say instead of doing this type of loan program, right, your buyer wants to negotiate a 2.5% reduction in the price. So they might say, all right, I'm willing to offer
$10,000 off.
So they're like, so your buyer might say, all right, I want to offer $392 on this $400,000 house, right? So what does that $8,300, if that's how you negotiated it, and then they just got a standard 30-year fixed, how much do you think that lowers their monthly payment by? Anyone want to take a guess? So instead of buying the house for $400, they're buying it for $392. What'd you say, Josh?
$40.
You're almost dead on, man. You're literally going to save between $40 and $50 a month. So would your client rather save $450 in the first year per month, and then another $235 in the second year per month? Knowing, again, the other caveat to this, it's the same theme that I'm trying to hit. We don't know where rates are going to be but the probability of rates being lower 2 years from now is a lot higher than them being the same or higher. So what you're doing is you're taking this small $8,000 concession and you're drastically reducing the monthly expense of the client to buy the home that they're trying to buy, because that's the number one thing is everyone's seen these rates go up. They've seen the prices of homes go up, and now that everyone feels like the affordability is not there. This is a solution for affordability. And this is going to save your client thousands of dollars over that first 2-year period of time. And let's say what I'm predicting, and I hope comes true, 24 months from now, I'm back on the phone with that client refinancing their loan to a 4.25% rate on the standard 30-year fixed market, because rates have come back down to more normal rates in 2 years. I've just did my last 2 contracts, both are under this loan program. This is not a niche. This isn't something that is hard for clients to grasp. It is simply this: can you negotiate a 2.5% credit? Because if you can tell your client, hey, I know rates are almost 7%. Would you like to have a rate in the 4s and in the 5s for the first 2 years of the loan? And if I basically we're rolling this through this 2.5% credit, and you're going to save a ton of money. And so, like I said, I've just did my last 2 deals. I've just locked under this loan program. That once the client saw it, they wanted nothing else.
You said the sellers have to pay what?
Say that one more time, Victor.
You said the sellers have to pay what?
So it has to be through a seller credit. So the buyer cannot pay for this program. The reason why the buyer cannot pay for the program is that the cost of it is actually, if you just add it up, 12 times 457 and 12 times 234, that's what it's costing to do this loan program. So if I'm a buyer, I would never pay $8,300 up front to save $8,300 over 24 months. You're getting nothing for your money. That's why you can't have the buyer pay it, right? So, but if you work in a seller credit, which, Josh, I know you know a lot about seller credits. Maybe some of these younger agents don't know a lot about seller credits because you guys haven't been able to use them very often. What would you say? I mean, are you starting to see the market open up to where this is going to be an agreeable solution for people?
This is absolutely, I don't know how many of you guys are out there representing buyers right now and are actively making offers, but I'll say the last handful of homes we've closed on have been for under list price. And so if I can negotiate under list price by, in some instances, like $20,000, $30,000, because sellers are a little bit more desperate these days, then surely I could negotiate this into the equation. What would the wording look like if we're presenting an offer? So in additional terms and conditions, David, what would you like to see as a lender in order for us to negotiate this as part of the contract?
So the initial offer can say something just as simple as 2.5% of the purchase price as a seller credit. You could list it as a dollar amount. You don't need, like, it wouldn't have to be something where you have to specifically write in an exact dollar amount, in the sense that you may not know what it officially costs once we get through and I've put this into my system in order to build the loan out. Those numbers might change. How much you've negotiated as a purchase price, how much the loan is, can affect the amount that it's going to cost. But if there's anything over, so like in this case, let's say this is exactly the deal we're working on, Josh. I would say one of two things. I would say negotiate for, say, 2.5% of the purchase price as a seller credit to go towards closing costs, prepaids, and 2-1 buy down, right? So you can add that verbiage into the language. Or you could do a round number. In this case, you might win to just say, $8,500, maybe even pad it a little bit, because I can still apply the credit as long as we're not going above the amount of credit that you cannot go above. And it's not a set number because some of it depends on loan amounts and down payment. good rule of thumb is most people aren't going to be able to get more than 3% due to the loan that they're doing. Okay. There's some government loans where you can get as much as 6% back, but you'd never go over 3% anyway in most cases. But if you said standard 2.5% as a credit, or if you wanted to use a dollar amount, in this case, I would say, you know what, say 8,500 as a seller credit, because I'd be anything over, I would just be using to pay for, appraisal fees, some title fees, it would go towards their closing costs as well.
A couple things, guys, that I want to, just on top of my mind, if you are going to be writing this into a contract, just reach out to your lender ahead of time and say, hey, I want to put this in. What's the exact verbiage you'd like to see? Additionally, before this call right here, had somebody written an offer that included that into the verbiage and sent it to me as part of an offer, I'd have been scratching my head like, what the heck does that mean? So what I'm getting at is you will have to educate the listing agent if you go this route. If you offered that to me, I would say no right away because I don't understand it. But if you educated me about, hey, instead of offering, $390, what we're going to do is offer you full price and we're going to get this credit on the back end. So then I'm like, oh, okay, well, I get it. And okay, purchase price is still going to be, list price. So a lot of educating the other side will be important if you're going to use this type of thing.
And is that generally how, do you do a lot of verbal negotiation prior to making the actual written offer? Or is it, I know in the hot market, you just kind of had to submit your offer, right?
Yeah. I mean, there might be a couple of texts back and forth or calls back and forth, but normally my first substantial contact is a written offer.
Is a written offer. Okay. And keep in mind, so in this case, let's say the list price is 400. They're not getting any bites on it, 400, right? You're coming in saying, instead of offering 390 as a purchase price, you might say we're going to offer you 400 with a $10,000 seller credit, for example, right? The seller is still netting the same as if they deducted the 10 from the purchase price, right? So the seller is not impacted by it in any way because it will drill down to whatever their net proceeds are after the credit, versus if they had agreed to sell it for 390 or sell it for 400 with a $10,000 credit. It does nothing against the seller in that example. And I mean, I'll touch on these. There are cheaper options, right? So for example, let's say 2.5% is too rich, right? You've got a seller very interested in your offer, but 2.5 is just too much to do. Or there might be a case where you're looking at this and thinking, okay, this house might not appraise. And if it doesn't appraise, then obviously we've got an issue that we've got to deal with at that point, right? And so if you've baked in a huge seller credit, the seller might not have, they might not feel great about the fact that now they're going to have to work with this lower appraisal. There are different, other than the full 2-1, there are smaller options where I can get a full % off for the first year, and that would cost less than 1%. So if you could get a 1% seller credit, right, I can still save your client for the first year with a 1% reduced interest rate. And so there are some different levels to it. The number one though is going to be the 2-1 buy down for that full 2 years, because you're really saving the buyer a ton of money every month. And it is basically giving them that 2 years, which is sort of the mentality that a lot of us have now, is that we're trying to reduce your payments for these next 24 months to kind of get through this higher rate environment. And hopefully we've got lower rates down the road where you're going to have another refinance boom. All of your buyers today are going to be refinancing their home at some point. I can almost guarantee that. So I know this is a unique thing. What kind of questions do you have? I mean, is this something where you feel you'd be able to, on your next deal, you're negotiating, you're talking with your buyer to buy a home? And is this a strategy that you could see yourself employing to help your buyer win a deal and overcome their objections.
If nothing else, guys, it's another tool that we have access to educate your buyers so that they feel like they're getting options. What questions do y'all have for David on this buy down?
Is there a limit to the purchase price?
No, but this is for a Fannie Mae, Freddie Mac loan, because again, this is just a standard conventional loan. The actual rate will still be but so it would have to be a conforming loan limit. So if it's say a jumbo loan, then we would not have access to it. But those loan limits are quite high. It's like 600 and I think it's going up to 625,000 next year. So we're going to be hitting a pretty high price point. So yeah, if it's the one-off where you've got say a jumbo sized home, it may not be the tool that we'll be able to use. But that's, those are, we all want millions of those, but we don't always get them. Anything else? Is this, like, think about it, if you're the buyer, you're the client, right? Is this something that when you look at this, is this something that would really, do you see value in it? I would love to get some feedback on how people feel about this overall program, because I really think it's a game changer.
For me, doing that educating piece is really going to be important, in that I don't understand as a buyer, $390, taking $10,000 off the purchase price sounds a whole lot better than an interest rate that I don't really understand how it necessarily works. But if you educate them on, basically what I've heard is every $1,000 means about $6. Every $1,000 of purchase price means $6 on your mortgage payment. That's kind of the basic rule of thumb. Does that still apply?
Yeah, pretty much. Yep.
Okay. So if I was to tell them, hey, you could save $40 a month because we're getting $10,000 less, or over the course of these next 2 years, you could save almost over $8,000. Which would you rather have? and then it makes sense to me.
Mm-hmm.
Is this math all making sense to you guys? If not, it's okay. David's here to explain. That's why I wanted him to talk and not me, because I have no idea what I'm talking about.
And I have a PowerPoint slide, basically a flyer that I'm creating. I wanted to make one myself so that I could have some language that I wanted to present to people. So once I have that, I'll be emailing it out to everybody, so that it can visualize it. And there is another component to this that I want to touch on, but yeah, I mean, does anyone have questions on how this works in terms of the math?
And I don't know what you're going to be covering third here, David, but what I have heard is, instead of us offering that $390, asking the buyer or the seller essentially to do what this is, but to buy us points. To improve our interest rate. Is this basically the same? This is basically the same thing.
This gets you way more of a discount on the rate for these 2 years than simply buying the rate down on a permanent basis. So yes, we could still do that same. So you could negotiate, say a $10,000 seller credit, and I could apply that to permanently buy down that person's rate. Okay. The problem is, well, not the problem, and I can present, and I do present that to everyone. I show them what a permanent rate down would be, and then I show them this 2-1 buy down, and then I show them, with no buy down or no sort of manipulation of the rate. The difference between the standard rate and the permanently bought down rate does not change the payment by anywhere close to as much as what this 2-1 buy down does. And so if you are of the mindset that in 2 years time, we might, or in even say 3 years time, we might have lower rates that you're going to ultimately refinance your loan with, then you will save way more money with this than you would permanently reducing your rate. If you feel like rates are going to be like this for a long time, or they might even go higher, then yes, it would. If that's the client, if that's the buyer's thought, then we would look to just permanently reduce the rate with the money you've negotiated as a seller credit. We can apply it to just permanently buy down the rate. But in this example, they would only save probably about $175 a month versus $450 and $230 for those first 2 years. Eventually, right? If you go long into the future, eventually the permanent rate buy down would be the better deal for them. But that's assuming that they never sell the home or refinance the home in a 4-year period, right? In the first 4 years. So great
sense.
question.
We got about 10 minutes left, and I definitely want you to get to this last one. So I started aside.
No, that's great. It's
tracked
not
you.
necessarily another program. What I wanted to touch on this 2-1 buy down, because it's not just for buyers, for your buyers clients. Okay. If you have a listing that's sitting there, it's not selling, and your sellers are kind of freaking out because 3 months ago, everyone sold their home in 5 seconds. And now we've been on the market for 2 weeks and we don't have an offer yet. If you're advertising any type of price reduction, or you're going to put in a price reduction, you could also use this tool, right, in a way to not only help attract a buyer, because you can say, we're going to offer a 2.5% seller credit to finance a 2-1 buy down rate, right? With, you can advertise, preferred lender, we can get you in touch. This isn't sort of what I would call the reason for this loan product that we've set up, but it is a nice sort of added benefit that you can have this discussion with your sellers and on your listings. You might be able to reduce less, right? Instead of a 10% price cut, you might do a 5% price cut and a 2.5% credit for this type of buy down, saving your listing from cutting as much. And it also could help attract more and more buyers by being able to advertise this in your listing. So it's just food for thought. It's basically another way to utilize this loan program in a way that helps you, not just with your buyers, but even with your listings as well. And so I just wanted to touch on that briefly and just let everyone know that is another way that realtors are using this type of loan program across the country. Is that something that you would take into consideration, or like, how do you feel like, or maybe that's a bit too much math and you've got to convert a buyer, whatever buyer comes in, you've got to convert them on the lender. That might be a tough sell, but I just want to, what are your thoughts, Josh, when you hear that?
Again, it's all about options to me. Like, being the best realtor doesn't necessarily mean you have all the answers, but giving your clients options and advice on those options, I think, is what separates the great from the mediocre.
Absolutely. And I guess I know we've got just a few minutes, but I have, basically I just try to get some market analysis from every time I'm talking to realtors. Obviously you're starting to see homes stay on the market for longer. What's the average time that a client, if the home's sitting there and it doesn't have an offer, what was historically the time that it would take for someone to say, I want to do a price cut to get some buyers? Like, what would have been the average duration maybe 5 years ago, Josh, or 3 years ago even?
I wasn't around 5 years ago.
You
But
weren't.
I've always heard the rule of thumb, 14 days, if without an offer or without X number of showings, then pricing needs to come down. Okay.
So within 2 weeks, you're figuring out that maybe it's overpriced or the market is shifting beneath your feet. That's pretty fair?
Yeah, as long as my marketing has been solid. I mean, homes don't sell for 3 reasons. This is what I tell people: price, marketing, or availability of showings. If it's not ready, or if it's not clean inside to show, if you're not allowing showings, and that's one reason, but pricing is normally the number one.
Yeah. So, I mean, this is just something to keep in the back of your head that, you know, if I've got a listing that isn't really doing well, this is something that you might be able to advertise. You might be able to at least put it out there that you've got this in your back pocket as an available thing to try to attract some buyers. So.
Awesome, guys. Well, I want to open it up. We've got a real life lender here. What other questions do you have? It doesn't have to relate at all
Yeah,
to these point buy
be anything.
downs or credits or anything like that. What other questions do we have in these last 5 minutes for our lender extraordinaire here?
Come on, Victor, you had a million questions for me the other night. Oh, did he jump off?
Well, I did put your contact information in the chat. So
Yep.
if anyone ever needs to get a hold of a lender that will answer your questions, please feel free to reach out to David. Otherwise, David, I appreciate your time. And I don't know about these other guys, but I definitely learned some things and things that will definitely help us here in the future.
I'll tell you, the thanks is all from me. I appreciate your time. I know you guys are getting hit up by millions of lenders all the time. My goal, my number one goal is to show every agent that is, you know, trusting me with their clients to help them. My goal is to show you how I can help you. I don't want to be the obnoxious lender that's calling saying, hey, I haven't gotten a deal I haven't gotten a deal in a couple of weeks. You know, I'm sure you're getting that all across the board. I'm sure you're getting hit up all the time. My goal is to consistently show you guys how can I help you sell more houses and help your clients in a meaningful way. And so it's all my pleasure to be here and to be able to show you these types of things that we can do for you. So.
All right. Well, thanks everybody. This recording will be available on our YouTube channel tomorrow. So thank you guys. David, thank you. We'll talk to you soon.
Thanks, guys. I appreciate you.
Thanks, Dave.